hoping, we thank God that we had a peaceful election like we prayed. And even if the process is probably not completely over, we just want to thank God for this far. And we believe that he will finish what he has started. So even as we wait for the next few days, let's continue praying that peace will prevail and that the country will move forward. And we'll continue with our business, even as we continue preparing for retirement. So today we'll be talking about an interesting topic, and this is about preparing for medical expenses in retirement. And this is a very, very critical subject. I am not yet retired, but I have interacted with retirees. I have read a lot on retirement and medical expenses. I have a few doctors I normally interact with and engage. But ultimately, in as much as medical issues are separate from finances, the point is we use money to take care of them. So here we are going to be looking at various sessions, and this is just the first of a series of webinars we will do on medicals. So today I'll basically focus more on the financial angle. That is, what are the broad categories or what are the avenues that you can use to prepare financially? But we'll also have a guest speaker, maybe in the next webinar or the one after that, where she will delve deeper into medical insurance for seniors. So many of us probably are enjoying medical insurances, but I have a friend who is focusing on medical insurance for seniors, and she'll try to probably give us a view of what are the premiums that you're likely to pay. For example, when you're 65 years or when you're 70 or when you're 75 years, but also what about the coverage? What will be covered, what is not covered, what happens when you get some conditions which become chronic, and then what happens to your cover next year. So we'll talk about that with our guest speaker, but hopefully we'll also get a doctor who can come and tell us about how we can manage our health today for those who are not retired, so that you can enjoy better health in retirement. But hopefully he'll also address, if you're retired, how can you best take care of your health so that you minimize your medical expenses. So today I'll first of all want to talk about retirement and well-being. Now, it is possible that some people's health improve after retirement, while others, their health deteriorate after retirement. And this has a lot to do with that transition, the change. So for those mainly whose health improved, probably they were working in a stressful environment, and now there is no work-related stress. They have more time to rest. They probably have more time to engage in physical activity. Maybe they can exercise, they can walk. And also probably they're doing something that they enjoy, and that has a positive effect in their health. But on the other hand, there are some people who retire actually because their health is deteriorating. So they actually go into retirement struggling with their health. Others, when they retire, the financial stress could actually be a trigger such that they start having health problems. For others, they may have the money, they may have good health, but because of isolation and loneliness, then they start getting unwell. We are told that if you're lonely and isolated, the kind of risk you carry is like somebody who is smoking 15 cigarettes a day. We know how harmful cigarettes are. So if you're isolated and lonely, that condition will actually kill you just as fast as smoking cigarettes. So loneliness and isolation actually kills. We are told that it increases your chances of death by 40%. But also other people get sick because of lack of purpose. So they have retired, their life was focused on what they were doing, but going forward now they feel like there's no meaning to life. There's nothing, their life does not count for anything. Therefore, preparation for retirement then becomes very, very important. And as you see, then it becomes a holistic way of preparation, because if you have financial stress, it will affect you. If you don't have a social support system, your health will be affected. If you're not living a meaningful life, if you don't have specific things that you're doing, that you feel you're adding value to other people, then you're also going to affect your health. So as we prepare for our medical expenses, part of it is ensuring that we are taking care of finances, social connection, and structure in retirement. But the other thing why we really need to prepare for this is that life expectancy is increasing. Globally, people are living much, much longer than they used to. At independence, which is slightly over 50 years ago, about 60 years ago, the life expectancy was in the lower 40s. Now it is in mid to advancing towards 70s. So in a span of 60 years, the life expectancy has grown by 20 years. And today, as medical advancements continue, as diagnoses continue to happen much, much earlier, many diseases are treated. We are suffering more now, not more from infectious disease, other than the COVID that, and probably the monkeypox at the moment. Most of the conditions that we are struggling with are not infectious diseases, but actually chronic diseases. Now, what are chronic diseases? These are diseases that will normally take long. You'll deal with them for a long period, usually over 1 year. And for some, they become lifelong conditions. Things like diabetes, heart disease, cancer, and even things like hypertension. I mean, those are things that you will continuously need to take care of. So management of those conditions becomes expensive compared even to the infectious diseases. Therefore, as we live longer and you're living longer with these chronic diseases, then it means you really need to have prepared well so that you can enjoy a good quality of life. So once then you start thinking in that broad concept, then we need to realize that we need to have money not only for insurance to cover our inpatient costs, but for many people, especially those with chronic conditions, they will need a lot of money for the outpatient care because you're probably on medication, constant medical checkups and all that. So it now becomes necessary to actually realize that insurances might not necessarily cover everything. So even as we prepare for these medical expenses, we need to ensure that even if we have a cover, like we saw during COVID, when a new illness or a new pandemic or a new condition comes, sometimes insurance do not cover these conditions immediately because they do not have relevant information to cost it. So we saw the industry in 2020 actually came forward and said they are going to cover those conditions, but they put limits. And for those who had to incur more expenses, they had to go into their pockets to pay for those expenses, even if they had good medical covers. So for that reason, then it is important that we actually plan to have premiums, but also money to cover medical expenses. Sometimes you need care outside the country. The kind of condition you have, sometimes you need to be treated out of the country. And some insurances will not cover that because they feel you can probably get a level of care here. Why spend money taking you outside? And if you want that higher level of care, then you will actually have to meet that out of your pocket. Now, in preparation for this, I don't think your children should be the people who you will rely on. Even today, as we see, most families end up calling other people to help them. So you probably exhaust your medical insurance, you exhaust your family resources, and now you actually call for a Harambee. And I think in the last 2 to 3 years, we've all participated in some Harambees. Some of the hospital bills are in excess of 6 million, 10 million, over 10 million. So what this means is that you really can't leave your healthcare to somebody else because they will probably also be dealing with their own conditions. And having probably enjoyed a very good care because you are probably working with a good organization that provided you with a very good medical cover, that sometimes comes as a very big adjustment. So you probably enjoyed being treated at the tier 1 hospitals, that is the Aga Khan, the Nairobi Hospital, the Mata Hospital, sometimes Avenue, MP Shah, and those kind of hospitals. But now when you're retired and you have to take care of your health insurance, you realize you might not afford to actually go to those hospitals. But I think the most important thing is not necessarily to have care in the tier 1 hospitals, but to be able to afford care. Of course, if you can afford more comfort and better care, then that is a plus. So it's important then that we look at the avenues. How are we going to do this? So there is not just one way of preparing for medical expenses. Today I want to look at four main ways. I'm going to share my screen so that you can go through this together. So we look at four main areas. We have what is now known post-retirement medical fund. For those people who are who have retirement benefits, who are members of retirement benefit scheme, we know in 2018, Retirement Benefits Authority gave us guidelines on how schemes can actually now incorporate post-retirement medical fund alongside the pension savings. And this is a good avenue for those who would like to utilize it. But there's also pension funds. Most people are in pension schemes. Some people are in provident funds. So pension schemes are the type of schemes that allow you to access a maximum of 1/3 of your accumulated savings on retirement. And you can actually decide to use part of that money you access as a lump sum to actually create a medical fund, and we look at that. But you can also do a lot in terms of investments. There are many investments that you can make during your career, or even if you are retired, there are certain investments you have made, but now you can earmark them to take care of your medical expenses. And another thing that you can actually use to build a medical fund is actually insurances. When I talk about insurances here, I'm not talking about medical insurance. I'm talking about other products that can enable you to have money to pay for medical expenses as well as for medical premiums. So we'll go into this, and we'll start with post-retirement medical. So post-retirement medical fund, basically how it works is that you have a separate saving alongside your pension that you put in money regularly, just like you do with pension, but the goal is to take care of your medical expenses. So schemes are supposed to amend their trust deeds to allow this, but even if your scheme does not do this, there are actually other schemes, retirement benefit schemes out there that accommodate people from other schemes or people who are not even members of any scheme. So it can be your scheme or any other registered retirement benefit scheme that has a post-retirement medical fund. So you can do this, during your career. So if you're a young person joining the labor force, you can just allocate 1,000 bob into this fund. Every month you put in 1,000 bob, and you see what happens in 10 to 20 years. Maybe Nova, I can ask you to do a projection for us. If somebody is joining, is employed at age 25, and they decide to put in 1,000 bob every month for the rest of their career, basically, and dedicated to post-retirement medical fund, what would be the value at age 60? I'll get back to you on that. So that we see the impact, because the longer you save, of course, the effect of compounding can actually enable you to have a good fund. So when you build this fund alongside your savings, one thing you need to know is that you cannot access those funds as long as you're in employment. Just like you don't access your retirement savings when you're in employment, you also can't access this medical amount while you're still in employment. You'd have to leave the scheme. You'd have to leave the employer to actually access that fund. But in case you are incapacitated due to ill health, with the approval of the trustees, they can actually allow you, because you'd be using the money for medical purposes. So if it's voluntarily, if it's any other reason other than incapacitation or emigrating out of the country, this is where you've probably gotten citizenship or permanent residency in another country, and you provide that proof to RBA, then they can allow you to take your money. So it's important to note that this money is purely dedicated for your healthcare in retirement. And so retirement benefits safeguards these assets just like they do with the retirement income. But what happens on retirement? On retirement, you can actually leave your funds in that scheme. You can choose, you can decide, you can take up to 1 year to decide what you're going to do with them. And one of the things you can do is actually to decide to leave the money in that scheme or to transfer the money to another scheme. Now, it's important to realize that you can transfer this to another scheme where probably you'll be accessing some money on an annual basis to pay premiums. But should you incur medical expenses, then you'll be requesting the scheme to pay the medical provider the medical expenses that you have incurred. So probably the scheme will charge you an administration fee or something like that. But there's also the option of, there are certain products in this market whereby you can actually buy your healthcare insurance at the point of retirement for the rest of your life. So basically, you will choose the level of care you want, and then they will do some calculations to tell you that you need to deposit a fund of this much. And out of this fund, you can enjoy an outpatient amount of this much, that is medical expenses when you're not admitted in hospital. And it also provides you with an insured, the insured inpatient. In event of you being hospitalized, the insurance will actually pay a certain amount per year. So if you want to make that long-term commitment, you can actually do it at that point. But if you choose to make an annual commitment with a provider, you can also maintain that money in a fund and be able to transfer or to access that money to take care of those things. So before retirement, you cannot access it unless you leave employment or you're incapacitated due to ill health or you're migrating out of the country. On retirement, you have time to decide. So you'll have time to shop around and to think about what you want to do. And you can also transfer that money to another fund. Now, the other thing that is interesting about this is that it actually allows you, to give approval through the trustees for your spouse to use that medical fund. So you might be enjoying good health, but your spouse might be unwell and they need that medical attention. So with approval of trustees, you can actually use that fund and they can actually benefit from that. And on death, in event of death at any one point, you will have nominated beneficiaries. They are normally paid that money as a lump sum. So it's important to note that this post-retirement medical fund works in very many ways similar to a pension, a saving for retirement income. The only difference is that in accessing the amounts, there are no restrictions as to how much you can actually access, because you're basically accessing to pay premiums or you're also accessing to pay medical expenses. So this fund would be especially very good for young people who are starting out in their careers. One of the reasons is because if your contributions for pension and also for post-retirement medical fund are within the 20,000 tax-free contributions per month, you actually get to enjoy that tax benefit. So you can just put in a little money and then it will actually progress quite fast, because later as your income grows and your contribution exceed the tax-free amount, then you will not be enjoying tax benefits. Now, for those who could be having high income, they're making high contributions in their retirement benefit scheme, but they're not disciplined savers, we also still encourage people to save here. You'd rather save something, even if it is not tax-free, and even if the growth is not as much as it would have been if it was tax-free, other than not save at all. So, but for those who are good at saving and they can actually discipline themselves and they can set aside money for a specific purpose over long term, then there are other options that you can actually utilize. So if you have a young adult in your household, or you know somebody who is joining employment and they have a retirement benefit scheme, it would be good to encourage them to save in a little bit in the post-retirement medical fund component. I don't know if Nova, you're ready. You can tell us if somebody invested 1,000 every month for between 25 and 60 years, that's 35 years, how much money would have accumulated at retirement, which would be probably dedicated to medical expenses? Nova, are you ready?
Yes, I am. Can you hear me?
Yes, we can.
Okay, so if someone saved 1,000 shillings from the time they're 25 until the retirement age of 60, they will have saved 420,000 shillings by that time. However, the accumulated interest would be 3,157,521. So by the time you're retiring, you'll have a total fund of 3,577,521 shillings.
Okay, what assumption have you made in terms of rate of return?
Yes, so the assumptions I've made are a 10% interest rate. I think that is, that's the main assumption, a 10% interest rate and a monthly contribution of 1,000 shillings. That's from the current age of 25 until the retirement age of 60.
Okay, thank you. Thanks a lot. So you see how you can actually do that. And of course, 1,000 shillings is something most people can afford, even those who are joining the workforce today. And as the income increases, they can actually increase that. Just imagine if you doubled that amount, then you'd have a fund of about 7 million. Okay, you might be saying 35 years from now, it's a long time. Still, 7 million will be a lot of money, and especially when it is dedicated to medical expenses. So let's continue. So when it comes to accessing that money, I have talked of how you can access, how it's accessible before retirement and how it's accessible on retirement, and other special conditions under which your family can benefit. So what you can decide on retirement is to retain their post-retirement medical fund. You can decide to retain it in that scheme or in another scheme, so that you'll be picking money from there and take care of your expenses. That would be a good way of managing, sometimes instead of accessing all the money and actually maybe diverting it to other courses. But you could also transfer it to a medical provider. And I believe, like I said, I know there's a medical provider where you can transfer the whole amount or whatever amount you arrive at, and it can actually determine what level of cover you'll enjoy for the rest of your life. And some people find that probably easier. Of course, there's the risk of how will this medical provider turn out in future, but I'm sure there are safeguards that are normally put towards that. But the other interesting opportunity you can actually take advantage of is to buy an annuity with it. So we use annuities in most cases with retirement income or with long-term saving. So what an annuity does is that it guarantees you an income for a specific period of time or for the rest of your life. So for example, you can decide that I will have an annuity that pays me an annual amount, which is probably enough to pay premiums and to probably keep some money in cash that should I need to buy drugs or see a doctor, or even sometimes if I exceed my cover, then I would be able to pick money from that. So the good thing with annuities is that it's a guaranteed option. There's no risk of loss of your money. And every year you'll actually have money to pay premiums. Later, I will show how you can actually use those annuities, both at saving towards it and also on retirement. So these are guidelines by Retirement Benefits Authority. These are the options that you have. So it's designed to help you take care of medical expenses, a specific goal, saving and investing for a specific goal. So that is one way. The other way is if you're saving in a pension fund, the law actually allows you to transfer up to 10% of your benefits to a medical cover provider. So that means that there's a limit here. You can only transfer 10% of your accumulated savings before you access your 1/3. However, if you want to put in more money, you can actually do that from your own income or from the money that you access. But direct transfer from the scheme to your medical provider, you can only do a 10% transfer. This is to ensure that you have an income, because if you transfer too much money again, you will have a cover which you might need, might not need, but you might be struggling to meet your everyday. However, there is no restriction for your additional voluntary contributions. So for those who make additional voluntary contributions, you can actually decide to use all of them or part of them. So some people, especially those who worked with one employer for a very long time, or those who may have changed employers, but they did not access their money when they changed employers, you tend to accumulate a huge fund. So you could actually say, I'll make sure I use about 10% of that, and probably I can add something else. And you can actually now have that at the back of your mind, that I'm saving both for my income and also for my medical expenses in retirement. So that makes it easier because you're making check-off deductions. Probably the investments are done in a protected and safeguarded way. And there's a whole regulator looking into the affairs of your investment. So this is an easy way that everyone, regardless of your financial literacy level, you can actually take advantage of. Post-retirement medical fund, and also growing your pension to ensure that you can actually use part of it to have a post-retirement medical fund. Of course, the other thing you can do is to look for money elsewhere and now decide that this is what is going to be for my retirement, post-retirement medical fund. So those are two related. They work in a similar way, but those are two ways you can actually do it. You can specifically set up a post-retirement medical fund through your pension scheme, or you can choose to use part of your retirement benefits to actually take care of your medical expenses. For those who don't have employer-sponsored retirement benefit schemes, like I mentioned, there are providers in this market who will provide a post-retirement medical fund, and you can actually join in. So we've looked at those two. Let's go to investments. And this is probably what most people have been doing. And we normally invest in various assets. So for example, some people enjoy investing in land, and you have many pieces of land. This is a very common scenario that I see with many of my retiring and retired clients. We tend to accumulate a lot of land asset. But what we know is that in terms of medical expenses, what you need is basically liquidity. If you have a piece of land, you could actually get sick and not get medical care, but that asset is there, because even if you're trying to sell it, land by nature is an illiquid asset. It takes very long to transact, even to transfer from seller to buyer. So one of the things you can do, if you enjoy investing in land, there's nothing wrong with that. You can invest in land, but as you approach retirement, before retirement, then you need to liquidate some of those assets that you want to earmark for medical expenses, and then put them in other assets that are easily accessible, such as unit trusts, somewhere where you'd be able now to access the money should you need it. So during your career, it's okay. You can invest in some of these assets. You can also invest in things like shares. Some people choose to start businesses, and then maybe they might sell their businesses, or they might wind down their businesses, and then you can use that money and actually earmark it for medical expenses. But another way of doing it is also using fixed income investments. So these fixed income investments are those incomes that give you a specified interest rates. So some of them are things like bonds or fixed deposit accounts. So you could save your money, invest in long-term bonds, and it doesn't matter whether you are retiring or retired. Some people who are retired usually feel like they don't want to invest in bonds because they are very long-term investments. But as I will demonstrate here, bonds are some of those things that can easily help you with your medical expenses, in the sense that they are giving you an income every 6 months, and you can actually use that to pay for your medical insurance premiums. And if you're not using all the money, you can actually put aside some money for outpatient expenses. Also, should you need a lump sum amount, you can actually liquidate your bond very, very fast. Within days, you can actually sell your bond. And once you sell your bond, you will be able to actually take care of your medical expenses, something that you might not be able to do with land. So bonds and fixed deposit accounts, you can actually build those investments and earmark them for medical expenses. Unit trusts will tend to be very, very useful, especially in retirement. Now, unit trusts are collective investment schemes. They are very similar to pension funds in the sense that they collect money from many investors. They are separate from the fund manager who sets up that fund, just like a pension scheme is separate from the employer. And they invest all the assets together and give a return to the members who have invested in that fund. Now, by nature, you can actually liquidate your investment in a unit trust anytime. So this makes it very good to put in money for medical expenses, because medical expenses tend to be needed urgently. In most cases, when you need to attend to something, you need to do it now or as soon as possible. So it ensures that easy access to your money. But also because of this particular unit trust, there are more unit trusts than these two. I've talked about I have here talked about money market and bond or income funds. So money market, usually they invest in short-term investments such as treasury bills or fixed deposits or interbank lending and those kind of investments. But bond fund or income fund, they normally invest in bonds. But they also they are also liquid. You can actually access your money quickly. The other unit trusts that invest in shares, I have excluded them from here because when you invest in shares, your value can actually keep going up and down. So you really can't say you are relying on that for medical expenses because your value might be low when you need it. And there's also what you call real estate investment schemes. So REITs, they invest in real estate. Those ones are structured a little bit differently. In as much as they can be liquid, they tend to have periods of a fixed period when you cannot access your investment, because normally they'll collect the money to do construction or to buy buildings, and that might require that they don't pay out for some time. So I have excluded those two, but money market, very liquid, you can get your money in 2 to 3 working days. Bond and income funds, similarly, because of what they invest in. So you could have money in growth assets like land, but when you liquidate them, you could actually put some in bonds and some also in money market fund or a bond fund. So the first bond, probably the minimum amounts are a bit high, 50,000, 100,000. But for the unit trusts, you need a minimum. Most providers will require 500 shillings or 2,000 shillings. That kind of amount of money, it's quite affordable. But even as you go through your career, one of the other things you can do probably is to dedicate your SACCO shares. In most cases, by the time you retire, you will not be having loans. And we encourage that you get out of debt way earlier than at your retirement age. You could stay in the SACCO shares, but but one of the things, again, I encourage is that when you're close to retirement, even stop guaranteeing other people loans, because you carry the risk of paying their loans if they default. And the fact that you'll still be having SACCO shares, even when you retire, the SACCO could actually take part of your savings to recover the loans you guaranteed. So you can actually decide, once I hit 50, I need to get into a low risk environment. My investments need to take low risk, and that includes what I do with my SACCO shares. And I can actually allocate them that when I retire, they will be my post-retirement medical fund. From my experience with many of my clients, most people have more than $1 million in SACCO shares. Some people several millions. So it can be a good fund that can pay your premiums, and also when you need to pay for medical expenses, it can actually do that. But some people also use insurances to create wealth. You may have had an education policy, but you're able to pay school fees from your income. So when the maturity comes, the insurance maturity comes, you actually don't need it probably for the purpose for which you had saved it or you had invested in insurance. You can actually use that money because it comes as a lump sum and actually put it aside for medical expenses. So depending on your circumstances, most of us can actually participate in most of these things. Maybe some people are not interested in starting businesses or investing in shares. Some people find it a little bit shaky, but all the other kind of investments, you probably have those assets. So even as you plan your finances, then you can actually decide this money, this investment, I'm buying this land. Specifically, I would want to liquidate it 5 years before retirement. And then once I liquidate it, I will convert it into an asset that will allow me to use it for medical expenses. If you're retired and you're holding a lot of stock in land, please consider liquidating some of that land, not just for medical purposes, but also for enjoying your life a little bit more. Not that probably you're not enjoying much, but the point is, when we invest when we are young, and we normally say we're investing for the later days, if you are retired, these are the later days. This is when you get to enjoy all those things that you have been saving. And even as we do this, it's important to know that the life expectancy is increasing. So you might be planning for 10 years, you could actually live for 20, 30 years into retirement. I just want to illustrate how you can use bonds. I have mentioned in the previous slide, how you can use bonds to actually serve your retirement, post-retirement medical purposes. So these two bonds have been issued this year. The first one is infrastructure bond. It was issued earlier in the year. It was also reopened again, I think last month or the previous month. And on the right is a bond that was issued this month. Actually, those who have invested in it need to pay money to central bank tomorrow. So this is a very, very current bond. So let's look at the infrastructure bond. The reason why I've picked an infrastructure bond is because infrastructure bonds, normally, when you invest in them, you don't pay tax on the interest you earn. So if you're able to invest in it, you tend to have a better return in the sense that there is no tax. But also they tend to be long-term bonds. So they also tend to have higher returns. So the last one had a return of 13.742%. That's a very, very good return, bearing in mind that it is almost a guaranteed return. The risk with bonds is very, very low. The government can use various avenues to pay your debt. They can borrow from me to pay you, something that is probably not possible with many other creditors. So if you invest $1 million today, let me start with probably somebody who is retiring. So you've decided to use some of the money you access from your pension and you want to use it for post-retirement fund. So if you have 1 million shillings and you could buy this bond, what it means is that you'd get an annual interest of 137,420. Now, depending on the level of cover that you want, this could be enough or could partially meet the cover that you want. So I have a client who is arranging their medical cover at the moment, and they are choosing to pick a cover of about 2 million inpatient, and that is going to cost them less than 100,000. So when you get this interest, then you are assured of paying your medical insurance. Then she can use the balance as an outpatient fund. When she needs to go and see a doctor, then she can use that money. Of course, if you have 2 million, double this amount, that means you could actually be having about 250 to 270,000. Probably your premium is 100,000. Even if it is 150,000, you have a sizable fund that you could actually use for outpatient care. So this can actually serve your purposes for 18 years. This bond is for 18 years. So if, for example, you invested 2 million, I think those who invested, I think $1 million and below, it will probably mature earlier. But if you have invested over a long period, you can actually guarantee premiums for your medical insurance, and you don't have to worry about that. So now you'll be left to consider other things, your income for other purposes, but you dedicate this investment to take care of your medical expenses. So is it a good investment? At the end of 18 years, if you won't have sold your bond, you'll have received a total interest of 2.4 million. In 18 years, it will have provided you with your medical cover, but you'll still get back your 1 million shillings, which again, you can decide what you want to do with it. So the total cash you will receive over the 18 years will actually be 3.473. So assume you're using your SACCO shares to do this, or your pension fund, you have accessed some of it cash and the rest has gone to buy you an income. So this is something that you can actually consider, especially for those who are retiring now. Even for those who are not retiring now, you can buy the same bond, but when the interest comes, you actually reinvest it. So you can wait until it is 100,000 or 150,000, and then you can buy another bond. Maybe it will not be an infrastructure bond, it will be like the next bond where you have to pay interest. But the point is you can keep reinvesting that money. And when you retire, you'll now have built a large fund from which you can actually pay. So an infrastructure bond has no withholding, you don't pay any withholding tax. But if you buy a regular bond, you will normally pay withholding tax. If a bond is the term is more than 10 years, the term is the last digits on the top row. IFB means infrastructure bond, and FXD is basically the fixed income debt. So it was issued in 2020. It was the second issue. This bond had been issued earlier, so it was reopened. The first issue was done in 2018, and it was for 15 years. So this bond, the interest rate is 12.7%, and you pay a withholding tax of 10% if it is more than 10 years. If it is if its term is less than 10 years, you'll pay a higher withholding tax at 15%. So you can actually say the effective rate is 11.4%, and the annual interest you'll get if you had invested the same amount of money is 114,000. And again, you can calculate to see how much you make out of it. So a bond still remains, whether it's infrastructure or the regular bond, it remains one of the best ways because it ensures that liquidity that enables you to cover that expense. If you never need the money, for example, you have saved this money, you have this fund for medical expenses, but you don't get sick, it's still a good thing. And you can actually utilize that money for other things, or you can leave it as an inheritance to your people. But the thing is, you will not be relying on other people for your own healthcare. You will not be a burden to other people. So that's how bonds work. This is just to illustrate how it would work. And now let's talk about insurances. So I chose to go back to my clients. So these are real insurances we have arranged. If you're my client and you can't recognize this, I have blocked your name and your date of birth. So you won't know that people won't know who this is, but this is a client who has a few years to retirement, and they realize that they don't have a post-retirement fund. Based on the assets that they have, they don't feel like they have assets that would enable them to either pay premiums when they retire or pay for medical expenses. So fortunately, they had some savings of 800,000, and we decided to invest this, to dedicate this money for post-retirement medical. So what we requested for here is what we call a deferred annuity. So a deferred annuity, how it works is that you bring in a lump sum and then you defer access to that money. You can't access that money for a period of time. So in her case, she expects to retire after age 65. With the organization she works with, she can work up to 70 years. So we decided to defer the money for 10 years. And also partly so that when she starts accessing this money, she can actually build a fund before she actually retires. So for her, the choice was that she would defer for 10 years and then she would access money in 5 years. So they highlighted here. So when the insurance company gives you quotation, they show you, you can access that money in 5 years, you can access that money in 10 years, 15 years, 25 years, and we even have what we call life annuities. You can also have an annuity that you will receive a certain amount of money for the rest of your life. So that can take care of medical bills, or it can take care of medical premiums. So for her, one of the main concerns we wanted to take care of is to build a fund where if she needs to see a doctor, she would be able to use that fund, but also should be able to pay insurance premiums. So we opted to have an income period. Once the 10 years are over, she will access her money in 5 years. And this is what I was talking about, liquidating or converting your assets into more liquid assets. So the plan is after 10 years, the first year she'll get 498,000. She won't need all that money to pay premiums. She'll probably need less than 100. So 400 will be put in a money market account or in a bond fund account where in case she needed that money, maybe the cover she had, she exhausted it and she needs additional money, she would have that 400,000. And that fund, in case she doesn't utilize it in the first year, it would build over the next 4 years, so that by the end of 4 years, she'll have more than 2 million that is accessible and that she would be able to utilize it if she needs it. And that money will remain invested. So at that point, then financial planning is a continuous thing you do. Depending on what other assets she will be holding, you can decide whether you want her to, she will keep some of it in money market, some of it will be in a bond, because even if she needed the money and it's in a bond, she would be able to sell it and take care of her medical expenses. So this is just an example of how, if you have a bonus, if you sell land, if you have an asset that has matured, you can actually decide, okay, I'll use money for other purposes, but I need to safeguard my medical expenses. Then I'll take a portion of it and then I will defy it. The advantage of this kind of insurance is that it enables you to keep that money for the intended purpose because it's not accessible. It's only accessible in retirement. Works very, very well with, similar to retirement benefits. So this is one example. So this is an example of 800,000 shillings for 10 years, but I have an example of somebody who is even much, much younger. So you're probably 35 years and you want to retire at 60. And yes, you have some money and you'd really want to take care of your post-retirement medical and forget about it. So this person actually took a cover of 1.4 million. And the money was deferred. She took a deferred annuity for 24 years. And what would happen is that at the end of 24 years, that 1.4 million will have grown to 14.28 million. And she can continue accessing this money for the rest of her life. This actually, we took a life annuity. So what it means is that she will continue getting a certain amount depending on the guarantee period. You can see this guarantee period. It basically means even if death occurred soon after you started accessing your money, the insurance company must pay the money to your next of kin for the remainder of the guarantee period. So for example, if she took a 10-year guarantee, it means every year, if she decides to take the money as a lump sum once a year, she could actually get 1.5 million shillings. She'll use part of it to pay insurance premiums. She'll use part of it to pay her outpatient care, but she'll still have a lot of money that should she need that money to cover treatment out of the country or to be in a more comfortable hospital if she's unwell, she would actually be able to do that. But even if she doesn't need the money, she doesn't utilize the money beyond the premium and the outpatient care, that money can remain invested. And you can imagine if you're going to receive 1.5 million for the rest of your life for a minimum of 10 years, then that is one burden off your mind. And you can actually now focus on living a more purposeful life because you really don't have to worry about medical expenses. Your trust is not in this money, but the point is you have prepared for it. If it comes, you'll be able to take care of it. So annuities, deferred annuities are one of the best ways that you can actually use to plan for your medical expenses. So those are the 4 areas I wanted to talk about today, some of the products that you can use. We've talked about post-retirement medical. We've talked about pension funds. We've talked about other investments. You can invest in whatever it is that you like, but you need to transition those investments into a liquid form that you can be able to utilize when you retire. And then also we've talked about insurances. I have chosen to use deferred annuities as opposed to the endowment annuities because deferred annuities tend to have a very good return compared to other insurances, like what you do for education policies. But even if you have that, that is still a good plan as opposed to not having. So when you're thinking about post-retirement medical, the principles of investing is that we normally talk about diversification. So one, you don't focus or you don't put all your eggs in one basket. You can actually utilize various products and various avenues so that you're well covered. Should investment not do so well, your retirement benefits probably will be doing well. Some people are in retirement benefits that do not post very, very good returns. So probably investments will be doing a little bit better. But it's important to look at the risk of what you're investing in, because with medical insurance, or I mean, with medical expenses, what you want is guarantee that if I want 100,000 shillings, I will have it. So most of the things I have talked about here, they tend to be guaranteed products. So annuities are guaranteed contracts. Insurance company gives you that quotation, and that is what you will get. That is what they promise to give, and that's what they get. It doesn't depend on the investment performance. Bonds, like we said, very low risk investments. When the government says they'll pay you this interest on this day, they make sure you have money on that day. Pension funds, again, highly regulated. Yeah, some can be risky, but we also have options that are not so risky, like the guaranteed funds that are offered by insurances. And sometimes you can actually switch at a certain point. For example, if you're in an employer scheme who's in a segregated fund, where capital and interest rate is not guaranteed, you can choose to put your post-retirement medical fund with a guaranteed fund where they will guarantee your capital and they will guarantee you an interest. Of course, you want to put your money somewhere where it will grow. You don't want to put 1 shilling today and still get 1 shilling after 10 or 15 years. Nova has given us how pension funds work, the effect of compounding. You'll only have saved less than 500,000, but the interest will be many times that what you have saved. So it will be over 3 million. So those are some of the products that you can use to accelerate growth of your savings. It's always good to work with tax efficient investments. If you get an infrastructure, if there's an offer for an infrastructure bond and a regular bond, please take an infrastructure bond because you'll save 15% of your of the interest. If there is a short-term bond and a long-term bond will save you on taxes, retirement benefits, especially when you've not exhausted the tax-free limit, you don't pay tax on the investment you're making. So always look out to be efficient in terms of taxes to maximize the return. Of course, most of these investments will come at a cost. Pension funds, there is management fee, there's RBA levy, but usually their costs are quite minimal. Bonds, if you invest directly with central bank, there is no expense. But if you invest through your bank or through fund managers, there will be a cost to it. Most fund managers will charge 1% of the value of bonds that you have with them. Avoid those providers who charge excessive costs. There's no reason why you should pay more than you should. Again, when you're choosing these investments, it's important that you recognize the phase of life that you are in. When you're younger, you can take more risks. When you're older, you have no time to take all these risks. You might need that money tomorrow. So it's important that also to look at what is in your portfolio and start transitioning it at the right time so that you're not suffering. You're not able to get the healthcare that you want, yet you have so much assets, but in a form that you cannot access at the moment. And of course, there are preferences. There are people who enjoy investing in land. There are people who enjoy doing businesses. So they would rather put their money in businesses than in a bond. We'll always have to factor that. You'll probably not be able to invest in something that you don't like. But you need to improve your preferences by educating yourself and also making small investments in these other investments so that you learn them. And once you learn them, you'll probably come to like them. So investing then becomes juggling all these things. And some of us get confused. Yes, I know I need to put a fund for healthcare. I need to do this, but where do I start? So sometimes you need help from somebody who either does this on a daily basis or is exposed to this kind of thing. Instead of just staying without doing it, without investing for your post-retirement medical, sometimes you can actually incur a small cost. And that is part of what I do. I help people, those who are younger and they're basically looking at their financial planning. I help them to plan, amongst other goals. Post-retirement medical and retirement income are basic goals that we must plan for in a financial plan. For those who are transitioning into retirement or they are already in retirement, now post-retirement medical now even gains greater importance amongst the goals that you do. So what I normally do is I work with you as an individual, or if you're married, you can come with your spouse. And together I can help you to clarify your financial and retirement vision. What is it that you want to achieve during your career, and what kind of retirement do you even want to have? And what that does, as we clarify this, you gain confidence in your decision making, and then you're actually able to build the desired lifestyle that you want. We are normally told that the best way to predict the future is to create it. So if you want to afford good healthcare in future, the best way is to invest to ensure that you have the money to buy yourself a good insurance cover, and also to pay medical expenses, out-of-pocket medical expenses. You can actually create that, but by planning. So I do this through a 6 weeks process. And the first week, we get to know each other. And I get to tell you how I do this and where I'm coming from. But I also get to know you, because I'll be helping you to make your own plan. So I use various tools to get to know your financial personality, your risk tolerance, even your personality itself, because what I've come to see is that it impacts how the process goes. But I also get to know where you are in regards to other aspects of life. Then the second meeting, we analyze your financial position. So we look at what assets have you accumulated, what liabilities are you carrying, if any, what are your income sources, and where is your money going? And that is just like a health checkup. When you go to see a doctor for a medical exam, they just tell you your cholesterol is this, and some things they highlight in red and some things they highlight in green. So that is basically what it does. So out of that analysis, we'll be able to see what are you doing well, what needs some improvement. And then the third session, we address what are those things that you want to achieve. Do you want to educate your children in a private school? Do you want to expose them to maybe international learning? You want to build a home? You want to have a home here in Nairobi and somewhere else? You want to advance your career, so you want to go back to school and do some personal development? We deal with all those goals. And then we prioritize those goals. In most cases, you'll want to do more than you can actually afford at the moment. So we prioritize, and we try to ensure that the things that also require focus, they might not be urgent today. Things like post-retirement medical. You might feel like you're tight on money. And so we say we'll get to it later. But if I'm able to convince you to just put 1,000 shillings per month, just skip lunch one day and put 1,000 shillings, we have demonstrated how that can grow into a huge amount. So we ensure we prioritize your goals, but we also take care of the most important goals so that they're not left behind. And then during the fourth session, I give you my recommendations in terms of how much should you save and where should you invest to achieve the goals that you have set in the previous week. So we are not just looking at growing money or increasing the money that you have, but there is a desired lifestyle that you would want to live now and even in the future. And so our investment will be the means to afford that lifestyle. So the investment strategies are for those goals. And then the fifth session, I talk about decision-making process. Money decisions are things you'll be making on a daily basis, but what I've come to discover with most people, and including myself, I didn't have a specific process. I take my decisions. So I would make, sometimes I would make decisions that are not best quality decisions. And many people attest, especially those who are a bit older, they've come to realize, yes, I have not made very good financial decisions. But this process enables you to make objective decisions, and even looking at your personality and seeing how you can sabotage yourself. Sometimes you make very quick decisions, or you take too long to decide on an investment and you lose time and opportunity. So this process helps you to make objective decisions that serve your best interest. And the last session, we normally look at one of the areas that require a lot of, a little bit more time and focus. For many people, they're struggling with work. They're wondering whether this is where I want to be. Is this what I want to do for the rest of my life? And again, work being the main source of income for majority of people. So we look at work and calling. What are those things that you are created to do? Are you doing them? And for those who are retiring, retirement gives you an opportunity to actually do those. For those who are Christians, we know of Ephesians 2:10 that talks about we are God's creation. We are created anew in Christ Jesus to do the works that he prepared for us way in advance. So what are those things God created me to do? Am I doing them? Many people feel like, no, I am not doing it. I'm only in this job because I need the money. But if I didn't have to worry about money, I would not be here. So we delve into that, and it's a process. I just guide you through the process. And then some people, those who are approaching retirement, this is usually very crucial for them because some are clear on what they want to do in retirement, others are not clear. So we start that process, but for some people, especially those who are in retirement and probably they are clear on what their calling is, we also address issues of wealth transfer. You probably recognize that you have more resources than you will ever need. And so you need to start deciding, how will I pass this to the next generation? And when will I pass this to the next generation? So we deal with that. So for that, I charge 55,000. This is a highly subsidized cost. For those who have gone through the process, I don't know if you have anyone here today. Many of them will attest that they would pay much more than what they paid because of the value that they get. So you don't have to struggle so much if you're not clear. And you could be clear on certain aspects, but not other aspects. So just like when we are unwell, we go to see a doctor. When we are physically unwell, when we are not so doing well emotionally, we go to a counselor to help us untangle what we are confused about. Even when you need to think about your finances and your retirement, you can actually get help. So if you're interested, I would encourage you to actually reach out to us and talk to us. So again, like Regina started at the beginning, I have addressed some of those issues in the book, Retirement Planning. If you don't have it yet, if you have not read it, or if you have read it and you think it would benefit someone, get them a copy. And you can actually get it in various bookshops. You can write back to us through the email that we give you the login credentials, and we can actually direct you if you need to buy from a bookstore. If you want a signed copy, you can always get it from me. But you can also reach me for various things, especially in regards to finances and retirement planning. So we've just discussed the financial and retirement planning. That is an in-depth coaching that will enable you to have a plan that you can work on over a period of time. But some people need training either as an organization or as individuals. You probably need to set up a post-retirement medical fund, or you need to set up an individual pension plan for yourself or even for your organization. I can assist with that. Some people have worked for various employers and they have left some benefits everywhere. And we encourage people to consolidate their benefits. I can help you with that, identify a suitable provider and then consolidate all of them. Some people are operating under gratuity. They don't have retirement benefit schemes, and they are promised a certain percentage of the income. One of the things you can do is to actually invest that. The employer may not give you the money, but you can convince the employer to invest that money on your behalf. Or you have access to your gratuity, and you meant it to provide for you an income in retirement. There are ways we can actually help you to invest it. We've seen products like annuities that can defer until retirement, but talk to me before you access it, because there are ways you can access part of that money tax-free. And of course, if you're approaching retirement and you need retirement income, you need to decide whether you want an annuity or an income drawdown, and you'll be having some lump sum money. You're wondering, where will I keep it? Do I just keep it in the bank account? We can open money market account for you. Some people will need to invest in bonds. We can facilitate all this. So thank you very much for listening in. I think now we can take some questions if there are any. Back to you, Regina.
Thank you. Thank you very much, Rose. We've really learned so much in today's session. So we can take a few extra minutes to answer the questions. There's somebody asking, can you access the full amount in the example that Nova was giving? And which is the other scheme that you can divert this money to?
So if you leave before retirement, I gave the ways you can access that money. You cannot access that money while you're still working, but on retirement, then this money becomes earmarked for post-retirement medical, just like you normally see with pension funds. If you wait until retirement, you can't access the money. You can't use all the money, get it as a lump sum if you're in a pension scheme, for example. So there are various funds. For example, where you are, that is a fund where you can keep them, you can retain the money. Like I mentioned, there are other independent providers who can continue investing your money, but in a similar scheme. It would have to be a similar scheme, just like we move money from one scheme to the other. So that is what will happen. You'll transfer it if you wait until retirement, or you can put it with a medical provider, but you are not allowed to access that money. So this money is specifically for post-retirement medical. If you access it, there's no guarantee that you'll be using it for medical purposes. So since retirement benefits have provided you with an environment specifically to take care of that need, they want to ensure that you do that. So at retirement, you either leave the money in the fund, or you transfer it to another fund, or you can buy an annuity.
Okay, thank you. And then, what is the annual escalation in insurances?
Now that depends on a lot of factors. And if you're here at the beginning of the webinar, I mentioned I intend to bring a guest speaker who will be giving us more details about that, because it depends on a number of factors. It depends on companies, it depends on the scheme you are in, it even depends on your own claims. If you make very huge claims, insurance companies can increase your premium, but they're not necessarily increasing for everybody else. Sometimes the whole fund makes losses and they need to ensure the premiums are adequate so that the fund does not collapse. So they increase for everyone. So be here next time when we have this webinar, and my friend will be able to go into details, and they can probably give what has happened in the past. But some people, you can enjoy a level of cover for some time without your premium going up, but sometimes the premiums are actually increased, but based on different things.
Okay, thank you. And we'll share the invite for the next session. On deferred annuity, we have two questions. First, what happens if the insurance company collapses? And second, must the money come from pension savings, or can you use non-pension funds?
Okay, good questions. So if the insurance company collapses, what happens? Now, insurance companies are regulated by Insurance Regulatory Authority, and part of the requirements, what insurance companies are supposed to do, and they do, is that they separate the insurance's money from the company's funds. So what do I mean? I gave an example that a pension scheme is usually separate from the employer, in the sense that it is set up as a separate legal entity. And when you contribute money and they buy assets, they don't buy assets in the name of the employer, they buy assets in the name of that pension scheme. That's exactly also what happens with insurances. So there is what you call the life fund. And this life fund is separate from the employer. If the employer is not able to pay their bills, to pay the employees and creditors, they cannot touch the assets of the life fund because they are not even in their own name. So the life fund is usually protected, and the Insurance Regulatory Authority requires that they periodically report to ensure that the liabilities they are holding, because they have promised you a benefit, they need to show that they have that money ready for you. So if the insurance company collapses, that fund is normally sold to another company. There was a company called Kenya National Assurance, for those who are old enough to have known about it, and there have been several life companies which have collapsed, but their pension fund and their life fund were actually sold to other providers. So that is what will normally happen. To buy a deferred annuity, must the money come from a pension scheme? No. It's just that majority of the annuities in this market normally come from pension funds, but if you have your own money from whatever source, you can actually come and buy a deferred annuity. The only distinction is if money comes from a pension fund, there is a taxation element. So whatever we talk about pension, the contributions are free, the investment income is free. At accessing point, then you might need to pay some taxes. But for money from other sources, there is no tax implication. So we need to know where the money is coming from. If it is coming from a pension scheme, they'll normally require a statement to show how the money was allocated between tax-free and taxed money. But if you're using your bonus or you sold an asset and all that, you just need to declare where the money comes from. So you can buy an annuity from whatever source.
Okay, thank you. Another question. Sorry, maybe you can talk about medical service providers for retirees.
Again, I will say that is what the next webinar will be on about. We intend to have the guest speaker who is doing a lot of medical insurance for seniors. So I would say we wait until then, but currently there are very, very many providers. Many insurance companies have come up with senior covers. So they have the standard cover for people who are below 65, but for those who are above 65 or even 50 now, 55, 60, they have specific products. There are several of them. There are several covers in the market. I think the last I did a check, I was able to identify at least 5 covers, which are specifically earmarked for seniors. Maybe I can mention the providers like APA. We have now Old Mutual. The cover was under UAP. We have Old Mutual. We have Britam. We have which one? We have CIC, and I'm forgetting the 5th one. But most of the leading providers actually have that cover. But those 4, at least, they're covers that I have interacted with them.
Okay, thank you. That's it for the questions, unless if anyone wants to unmute and ask their question. We have a few compliments. The crowd is saying, great session. Thank you, Rose. Very informative session. Thanks, Rose. Again, just thank you for this very informative session. And the contacts are on screen. In case you may turn to ask any further questions, please do get in touch with Rose. Also, for those who came in a bit late, we are going to upload this recording to our YouTube page and also share the link with you via email, and also the invite for the next session, since I'm seeing that most of us are anticipating for it. So that's it on my end. Rose can give us the closing remarks.
Okay. Yeah, thank you very much for attending and being attentive all the way to the end. We appreciate your feedback. For those who have requested that we speak about certain things, we are definitely planning for that. Feel free to share more information on what you'd want us to talk about so that we prepare content that will be helpful to you. But I also want to encourage you that you purpose to take action with what you learn. So that you don't just have a lot of information, but you struggle with implementing them. We all need these things. They are available in the market. We can actually do that. If you need help, please reach out. The first call is free. I'll not charge you for free consultation. Let's talk. Let's get to see how we can work together. For my clients who are here, thank you again for being here and always being here. There are regular people who are always in the webinar. We appreciate that you come. So maybe what I can point out is that this time we had our session on the 3rd Thursday of the month. And basically it's because of what was happening last week. We knew people would not be in the right frame of mind to listen to our webinar. So now that hopefully this is behind us, we will revert back to the 2nd Thursday of the month. So the next webinar will be on the 2nd Thursday of the month at 6 p.m, God willing. So until then, keep safe and maintain peace.